Hello friends, welcome to the Art of Accounting. Friends, today in this video we will learn about basic accounting terms. Basic accounting terms consist of small words that have their own meanings. Thus, these are many words that are used frequently in accounting. Today let's learn about them and what they mean. So all these basic accounting terms are called basic accounting terminology. So in accounting terms, first we learn about the business. Let's understand what is called business. Business, an organization or an economic system where goods and services are exchanged for one another or for money, called business. Second, proprietor or owner. Proprietor, who runs an organization and invests their money in business. An owner has the right to take any decision for their business. Capital. In accounting, capital means anything brought by the owner into the business in cash or in kind of any item. Capital means that balance amount of assets which is left after a subtracting amount of liabilities from total assets. Drawings. Any withdrawal by the owner from the business in cash or in any kind of item is called drawings. Let's understand with an example. Business. Aman, suppose a customer Aman invests cash into half store. This is half store. Aman invests cash into a half store. It's called invest the cash who Aman. So this is capital. This is capital. Proprietor, business. Drawings. Half store Aman withdrawn cash from half store owner. It's called drawing. Half store is drawing. Business transaction. When one business does deal for goods and services in the form of in cash or credit with any other business or an individual is called business transaction. Right? After business transaction, divided into two parts: cash transaction, credit transaction. Cash transaction, let's understand with an example. Sam store sold goods to Ram, paid in cash. This is the cash transaction. And Ram store purchased goods to Jagan on credit. This is the credit transaction. After coming to debit. Debit is DR. In accounting, a debit is an entry made on the left side of general ledger account. It represents an increase in assets or expenses and a decrease in liabilities, equity or revenue. After coming to credit. Credit is here. In accounting, a credit is an entry made on the right side of a general ledger account. It represents an decrease in assets or expenses and an increase in a liability or revenue. Purchase. When a business buys only goods, then it is the purchase. Sell. When business sell only goods is sell. Purchase return or return inwards. Where business received goods not according to sample, then these are returned to the vendor or supplier is known as purchase return. Sales return. When customer returned goods to business is called sales return. Assets. Something valuable that a business owns get benefits from its future or has use of in generating income, called assets. Assets divided into three parts: fixed asset, current asset, fictitious asset. What is fixed asset? Those assets on which the business will get benefits for a long period of time, known as fixed assets. Fixed asset is known for long term, means in a long period of time, known as fixed asset. Fixed asset divided into two parts: tangible asset or intangible asset. What is tangible asset? All those assets which have physical existence known as tangible assets like building, plant, machine, land, etc. Intangible asset which do not have physical existence called intangible assets like goodwill, trademarks, patent, copyright, etc. Current asset, those assets which are used within the period of 1 year known as current asset, also known as short-term assets. Short-term assets like inventories, cash in hand, bills received, etc. Fictitious asset, fictitious assets are preliminary expenses, promotional expenses, discount to allowed on issues of shared debentures. This is the fictitious assets example. After coming to liabilities. Liabilities is something valuable that a business owes loans have to pay in future, called liabilities. Liabilities divided into three types: fixed liabilities, current liabilities, contingent liabilities. What is fixed liabilities? A fixed liability is a type of debt, bonds, mortgage, and loans that are payable over a term exceeding 1 year, like debenture, mortgage, long term loans, etc. Second point, current liabilities. Current liabilities, creditor and other outstanding expenses that are expected to be paid within a year, maximum 1 year, called current liabilities. Current liabilities like are short-term loan, creditors, bills payable, outstanding expenses, etc. Contingent liabilities. It refers to that amount which may or may not become payable in future, called contingent liabilities. Friends, that's all for today's video. I hope you found this video helpful.